Hi, my name is Diego Mendez. I'm a bankruptcy loan modification foreclosure lawyer here in beautiful Miami, Florida. I've been doing this kind of law for the last 13 years, helping people who cannot afford their homes, dealing with loan modifications, bankruptcies, and other situations where people are unable to pay their bills and getting people back on track and saving their homes. I've been doing this channel, Debt Law, Survival Guide for the Desperate Debtor, for the last few months, and I've been getting a lot of likes and a lot of subscriptions. And what I would like is for you to like this video and subscribe to my channel so I keep making these videos and keep focusing on the things that people are talking about now that the coronavirus is over and we're moving into a normal economy. One of the questions that I'm getting a lot, and what we're going to focus in on this particular video, is what happens after the forbearance and you want to refinance. It's a tricky situation. It's actually not as straightforward as a lot of people think. So we're going to talk about that in 5 seconds. So 2020 was really hard for a lot of people. Some people lost their jobs, they were laid off, their hours were cut, their pay was cut, maybe one of the spouses lost their jobs, or there was a sickness, or God forbid, a death in the family, and it caused a snowball effect where now they are facing the end of forbearance and they can't pay their bills. So people are looking for different options on how to get a lower payment, how to get themselves out of a situation where now they can actually come out and pay their bills. One of the things that people think about is refinancing. Now, there's a very specific thing about refinancing that you need to understand after you've been even 1 month in forbearance. In order for you to qualify for a refinance with a new bank or with your current bank, you need to make 3 separate regular payments to your bank of your regular mortgage payment after forbearance. That's called the 3-month rule. Now, what happens is that you come off forbearance, let's say you came off in June of 2021, you need to make July, August, and September payments on time, and you need to make those 3 payments. You can't do a lump sum of the 3 months to speed up the process to do a refinance right now. If you were to do this right now, you would have to wait till October. I would say it's actually a 4-month rule, because after the 3rd month, that's when you can actually start applying. So you're still gonna have to keep making your mortgage payments until your refinance is approved, if it's ever approved. Now, the question is, and what we're going to talk about here, is we all understand why people want to refinance. Basically, people are looking to lower their payments. That's the number one reason why anybody would want to refinance. But there are some considerations on whether or not you should refinance. Now, consider this. There are 2 things you need to understand when you refinance. Number 1, there are closing costs. This is not a free thing. Mortgage brokers and people that do refinancing don't do this for free. This is a service, so you're gonna have to pay for that. There are points, there are things that you need to understand that when you do the refinance, that is all gonna be added on to your loan. Your loan is going to grow with the closing costs. Now, it might not be a big deal if you owe a lot, but let's say you owe $70,000 or $80,000 and you end up with $7,000, $8,000, $10,000 more on your mortgage. That is a big deal. That's a big percentage of your mortgage, so it's something to think about. The other thing to think about is that when you refinance, the clock starts over with the interest. That means that you get a brand new 30-year mortgage in a refinance. If you were trying to pay off your mortgage month by month, making regular mortgage payments, now you've added many more years. Let's say that you were 7 years into your mortgage and you refinance now. Those 7 years, they haven't completely been lost because you've made a little bit of progress on the principal, but for the most part, you're starting over. You're starting to have to pay all that interest for the next 7 years plus 23, 30 years, and you basically started over the clock. So if it's important to you and if you're looking to pay off your home with regular payments, that's a consideration. The other thing, which I think is even more important, is to understand that a lot of people don't really understand what they're doing when they refinance. When you're refinancing, what you're basically doing is you're getting another bank, and in some cases your own bank, to give you a brand new loan. This is something that people don't get. They think, oh, I'm just signing these paperwork and I'm just gonna, do this thing and then I'm just gonna get a lower payment. But in practical terms, another bank is gonna be your bank in most cases. Now, that doesn't really matter to most people. However, there are certain people that when they bought their house, they bought with very special government mortgages. These government mortgages are FHA, Fannie Mae, Freddie Mac, the VA, and USDA. These mortgages have been shown to be very special. When the CARES Act was passed right in March of 2020, the CARES Act covered government mortgages. It did not cover other mortgages. So anybody who did not have one of those mortgages, FHA, Fannie Mae, Freddie Mac, USDA, or VA, was not covered by the CARES Act, therefore did not have all the special protection that the government can give people with those mortgages. When you refinance, most of the time you lose those mortgages because it's commercial banks that generally refinance. Sometimes you can go FHA to FHA. You need to be very careful that if you're going to refinance, that you try to keep your FHA mortgage if you have an FHA mortgage. Don't go to a commercial bank that might be offering you a little bit less, because when you go to that commercial bank, you lose all of the protections of the CARES Act, of any future government law that's going to be directed to government-backed mortgages. If there's another pandemic or a financial crisis of any kind and the government wants to direct assistance to people who have government-backed mortgages, you're gonna be out of luck. If in this situation you were able to get an 18-month forbearance because you had a government mortgage, next time around you won't have that. So think once, twice, 3 times, is it really worth it, this $100 drop in payment that will probably be eaten up by the escrow in a couple years anyway? Is it really worth losing your FHA or your VA loan just to get a little bit less now? Those are serious considerations. Make sure you think about what you're doing before you refinance. Now, obviously, if you need the lower payment and you need to refinance, do what you need to do. But consider all your options. Again, my name is Diego Mendez. I'm a bankruptcy, loan modification, and foreclosure lawyer here in Miami, Florida. I've been doing this kind of law for a long time. I've been doing this channel for a few months. I'm getting a lot of feedback. I very much would like you to like and subscribe to my channel so I keep making these videos. I keep focusing on the things that people are talking about, and I keep trying to help people with all this good advice that I think is good advice about what to do when you're coming out of forbearance and into the future. Thank you very much.